but we're going to get started today, and I'm going to introduce Jim Jen, and thank you for coming today. Jim is the Chief Operating Officer for InnovationWorks, where he leads investment and platform activities across software, hardware, and life science sectors, and is a Managing Director for Riverfront Ventures. Jim has helped launch nationally ranked accelerators AlphaLab and AlphaLab Gear for IW, and recently helped launch AlphaLab Health, a life science healthcare focused accelerator in partnership with Allegheny Health Network. Jim has led initial and early investments in over 100 early stage technology companies, including Ecos, Jazz HR, No Wait, acquired by Yelp, ShowClicks, and Wombat Security. Jim previously led product at venture-backed companies in California, and Jim holds a BA and MA in economics and an MBA from Stanford University. So Jim, I'm going to hand it over to you.
All right, thanks a lot, Allison. Thanks everyone for joining in, and looking forward to having a conversation about investor presentations, and as I've called it, sort of beyond the pitch. And I'll go a little bit more into detail about that. You've already gotten my background, so I'm going to keep going here. In terms of, I'm part of InnovationWorks. I thought I'd take a moment to give the overview about InnovationWorks. I think, as Allison said in the intro, we have a focus across 3 technology sectors, broadly software, hardware materials, life sciences. And of course, that covers many of the subsegments underneath it, whether it's AI, robotics, medical devices, HIT. And then we provide funding across different stages. And we believe this is a really strong differentiator for InnovationWorks. We have funding at the accelerator stages, which you'll see to the right of the slide, really to help companies get through initial stages of validation. And we also have a seed fund to invest in companies to help them really gain repeatability in their business. And we have a for-profit venture fund, Riverfront Ventures, that invests as part of institutional rounds when companies are ready to grow. We also have a strong network of investors that have co-invested with us in companies that we've had in our portfolio over the years. And then alongside, in addition, we also have built out strong networks for our companies, university partners, corporate partners, mentors, to help the companies with the strategy and the day-to-day as they build their business. And then finally, our accelerator programs that Allison mentioned, AlphaLab, AlphaLab Gear, and AlphaLab Health, are very immersive, hands-on support for companies through some of these early stages. And just a little bit about InnovationWorks' track record. As you can see, over the last 20 plus years, we've invested in over 500 companies. Those companies have gone on to raise several $billion of funding, and we've had numerous exits. And really, I think the key from that is because of all of these transactions and companies we've worked with, we've really seen a lot of companies, we've seen their pitches, we've seen the terms in their funding rounds, what level of traction they were at when they raised investment. And we bring that to helping the entrepreneurs. And really a lot of that has formed, that experience has formed a lot of what I'm going to talk about today. So beyond the pitch, why call it beyond the pitch? The goal here is to hopefully provide some insight into how investors will think about your business beyond just kind of, the slides and the content of the pitch, but using the pitch framework as a way of talking about it. But I think the key is that you can only optimize for so much at the pitch. And so that's why it's important to get to the underlying business of your company. And I think a few caveats. This isn't focused on fundraising strategy or process. So, how to execute a fundraise or even some of the strategy. I touch upon that at the end, but that's not the focus. Definitely, this is focused on early stage presentations, pre-seed and seed, not a series B or C, where I think you'll shift a lot more to financial performance, metrics, and growth. If you are entering pitch competitions, this format may not work. I think the main advice there is definitely follow the rules of that pitch competition and their guidance. And then finally, a very important point I want to emphasize is the investor pitch is very different from your customer or sales pitch. In fact, I would recommend that you sort of create both separately, and you don't create one and then try to morph it into the other. We'll talk more about what an investor pitch looks for, but a customer pitch has to really probably get more specific, show you understand the industry, you understand the problem, probably more product focused, whereas the investor pitch will talk about your product, but is more company focused. So kind of with that, let me kind of dive in. In terms of the format, often we're asked, hey, what format do you recommend? Is there a template? And so I'm going to talk about a few common ones, but then and give you my view of what I like to see. The 10-20-30 rule, Guy Kawasaki, he was part of the original Apple team, as well-known evangelist, marketer, and investor in Silicon Valley. And so his 10-20-30 rule is very well-known. He's written books covering this. And I think it has most of the key points here: problem, solution, business model, competition, go-to-market, team. And you'll see those in probably a lot of the different templates or suggested formats. Share another one, Rob Go from NextView Ventures, who NextView as a firm and Rob as a partner blogs a lot about the fundraising process, especially seed stage. And they're based out of Boston. So I always like having, showing a West Coast point of view, East Coast point of view. And he blogged a couple years ago as well about the format that he likes to see. And again, you can see some of the elements here: team, what do you do, market, but they put it in sort of real world terms that I think makes it a little bit more accessible so you can see what they're trying to get at. I think everyone has a framework. If you do a Google search just around pitch deck outlines, you see there's just tons, pages of examples. I know that Right Side Capital has talked about a boom slide, the idea that your first slide just has to, really have a punch. You put your very best things in the first slide, so the boom. Draper Triangle, a venture firm located here in Pittsburgh, I know when they've come and spoken to our entrepreneurs, they've talked about the 5 M's, and market, momentum, management, money. And I believe the 5th one is metrics. I was trying to remember them this morning. But and again, they're all getting at the same core set of things, but different ways that firms like to look at it. And then, me as well. I really like to start with kind of a high-level thought for entrepreneurs around the investor pitch. It's the compelling market opportunity vision. So this is the bigger picture, the vision, what this company could be if everything goes well, and this is the dominate the industry type of thinking. But and I really want to emphasize evidence that you're the one. So this is where it's the other things you hear about. You want traction, you want metrics, you want a focused execution plan. And sometimes I've had entrepreneurs say to me, they feel like they hear conflicting feedback. Some people say, hey, you're too unfocused, you're too broad, and others say, hey, your vision is too narrow, you're not thinking big enough. And really what I want to talk about is how you balance both of these things to make sure that you're appealing to both sides of the investor. And then the evidence, and these are some of the specifics, again, around team, customer problem, where you're at, your plans. That's what I'm going to dive into more detail. So maybe I'll pause for now and see if we have any questions. Allison, if we have any questions, I'll take them, or I can keep going.
There aren't any in chat, but if anybody has any questions right now, let us know.
Well, I'll keep going, and then Allison, feel free to jump in if we get some. So first, the first part, the big, part one of this is the compelling market opportunity and vision. And kind of what is that? And really my hope is to try to give some specifics to give you a sense of what investors are looking for. So it's not just enough to say, hey, this is a big market, or to show statistics of how many dollars are spent in that market, although that's a good start. But what really will make you stand out in a pitch with an investor is if you have a unique point of view about that market, some of the trends affecting that market, and a vision for how a company could take advantage of that opportunity. And of course, that company is yours. And so that is very important. And I think here you're really trying to appeal to actually a little bit of an emotional side of the investor, where they're like, wow, that's exciting. I think there's a big opportunity there. Tell me more. So really it's important to get this part right, because you have to paint the picture that this is a market worth going after. And so that, because if it's not worth going after, then the rest of your presentation, who cares? And then I think from an investor standpoint, the reason they care about big market is a lot of time the way investment funds, especially VC funds, are set up, the fund economics dictate that you get a certain return on the investments. And so there's often saying that when investors are looking at each investment in their fund, they can only make so many investments. They have to feel like each investment could, in and of itself, sort of make the returns for that fund, which often is, for example, a 10x return. So if they're investing in your company at a post-money valuation of 10 million, and you assume there's going to be additional funding and dilution, at a minimum, they've got to be seeing at least a pathway to $150 million, $200 million exit. And honestly, that's probably on the low side. And that's why you hear about investors looking for $1 billion opportunities. So now kind of go back to the evidence part. And the first thing is team. And I'm sure that as you talk to investors or as others come and talk, everyone says, hey, team's important. And it is, especially at the earliest stages when you're still taking a leap of faith on kind of the product or customers, really feeling, that the team is differentiated is important. So I think a couple of key points here is the unique qualifications. I'm making an assumption that everyone on this call is very high caliber and would be viewed as strong from a team standpoint. But really, to get to that next level is, how do you stand out? How are you truly unique? And there's a concept that investors talk about, which is founder market fit. So often you've heard of product market fit, but another term is founder market fit, which is the background or the skills of the founding team. How well is it suited to go after this particular opportunity? So whether it's industry experience, that they know this industry that they're going after, they have the contacts, or it's functional experience. If you're a consumer product, then they're probably going to look for some relevant prior consumer experience. Did you work at Duolingo, for example, or you've had experience with some key, do you have experience in digital marketing? You know how to acquire customers online. Or if your company is really more of a technology platform, then they're going to be looking at the technology backgrounds of your team, so on and so forth. The execution, obviously, and this will tie in with some of the things we'll talk about later, is evidence of your ability as a team. Team chemistry is very important. If you are in the pitch meeting with an investor and there's multiple founders there, you've got to find the right balance of not having the CEO do all the talking, because that potentially raises concerns with investors, but also not having all of you talk over each other, potentially contradicting or repeating what others says, because that's also a flag for potentially bad team chemistry. And a note that I've told before is that I saw a company lose a VC investment because of this issue. In a meeting, the VC picked up on some potential dynamics with the management team. So then, as their next step in due diligence, they asked to speak to all the management team members one-on-one. And in their one-on-one conversations, they came up with the conclusion that the team was not on the same page and ultimately walked away from the term sheet. And then finally, coachability. And this is another term you're going to hear a lot. And what does coachability mean? I think one thing that's important is that coachability is not agreeing with the investor. So it's not agreeing with everything they say and thinking everything that we tell you is a great idea, but it's how you engage with us in that discussion. So if we do provide feedback or ask you questions about a part of your business model, go-to-market strategy, it's having a very engaging, productive dialogue about that. And so I think through that, investors then get a view into, how you think about problems, how open are you to getting data and feedback that might suggest some pivots or changes in your approach. And that's an important element that the investors are looking for, kind of as they're working with you, even to get to an initial investment, and really trying to figure out, hey, how much growth is there going to be in not only this company, but this investor-entrepreneur relationship, and how good of conversations are we having around what's happening in the business? Next one is the customer problem, and really understanding the customer problem. And I think the way you differentiate is if you really can show that you understand it at a detailed level. So a detailed segmented level that you can articulate between different segments of your target customer, the little nuances that makes one segment different from another, and then how that informs how you're going to go after the market. So for example, if you in a conversation, you're saying, this segment of the market is like this. We think they're early adopters. We think that our product's initial value proposition, is going to be more important for them. And then this other segment we're going to go after later, after we've built out these capabilities, that starts showing that you do understand your market at that deeper level. And I think the second point ties in with that is really be able to find your target market well enough so that they're reachable. So whether it's through your techniques in terms of prospecting, finding customers, or advertising to them online, or if you're asking for intros from mentors, it's very important to be more specific. For example, if you were to ask your mentors, hey, could you introduce me to someone in the consumer products market? Consumer products helps, but it's not as detailed. But if you can get specific, say, hey, I'm really looking for someone who is in the retail segment of the market, really going after sort of specialty interests such as sporting goods or hunting and fishing, and that has, kind of is focused on merchandising at the retail level. Well, that makes it a lot easier to think about, do I know someone I can introduce you to? So, and then finally, the how intense a problem this is. That's another important factor. You'll see that later when we talk about the value you're adding. But just because there's a customer problem doesn't mean they're all equal. So a lot of times investors try to figure out, well, in the list of problems that a customer has, where does this rank and how strong is this problem? And this ties into sort of the unique product enough value. And really, I think a lot of this is all around differentiation, right? Yes, there's a problem. How well does the product currently solve the problem? There's also a secondary discussion you'll often have, which is around, defensibility. And often the question you'll get is, what's your IP? Do you have patents? But I think often, especially with software products, there may be ways that you can answer that even if you've decided not to go after patents. I think in hardware and definitely in life sciences, the IP portfolio is much more important. But really what an investor is asking for is, how defensible is this? So when you're starting to be successful and show there's a market, how do you prevent others from just coming in and copying what you do? And be able to overtake you because they have a stronger brand, they have distribution, or they have more money. So I think those are, that's the kind of what's behind that question. And I think, again, for software companies, the data or the network effects also becomes things that become differentiation. And then finally, it is the proof, so it's the metrics. It's whether it's engagement metrics, retention metrics, definitely, especially with B2B companies, ROI. So how much money are you saving them or bringing in, and be able to measure and quantify that. Kind of traction and momentum. That's probably another term you'll hear all the time. We want to see traction. We want to see traction. And it's elusive to try to get that definition. What is traction? But I think it's several things. There's a quantitative number. It's like, how many customers do you have? What's your revenue level? Or how many users do you have? But it's also, there's a quality level that ties into the engagement we talked about earlier. How often are they using it? Are they coming back? How well are you retaining your customers? So those are probably two dimensions that you have to think about when it comes to traction. And then sort of related to that is understanding, well, how did you get those customers? And what's also important is this last bullet about the baseline, is that investors often want to see that growth and momentum. So especially if they meet you, if let's say you're working on your startup right now, your first year at Schwartz, then maybe second year, they're going to want to see what progress you've made. And they may remember kind of where you were at a year ago and kind of see, kind of the growth and momentum. Moving forward. And with customer acquisition, this again ties in with traction, but it is around how are you going to get customers or users, and can you do it repeatedly and profitably? And so this will vary by stage. In the early stages, I think investors just want to see that you're on the path to repeatability, that there's starting to be some consistency in your customers and how you've gotten them, but they recognize you're still early. So they also want you to just, go get customers, even if it isn't the most scalable method. But as you start trying to raise larger rounds, proving out this repeatable process is more and more important. And, what channels are you using? What are the cost of acquisition? And is this a profitable channel for you? Which then ties into we're nearing the end here on some of these points, and then we can talk more about it, is the viable economics of your given business model. And I think this is really a key part of what investors are also thinking about. So it's really ultimately, how profitable can this business be, or what type of margins can you get? Oh shoot, let's see. Excuse me here. Thought I had turned off all my pop-ups, but it's looking at the industry and the business model. So for example, software as a service model, in general, high gross margins, and because recurring revenues, investors really like that, because if you have a compelling product and you can retain customers, then your lifetime value of those customers is quite high. If you're a hardware company and you're selling hardware, then they're going to look a lot at your gross margins and figure out how much money you're making on each unit, and trying to figure out with scale how much the cost can come down. And then if you have more of a transactional model, whether it's e-commerce or marketplaces, then I think the unit economics really come into play, is that on each transaction, kind of who gets what, and can you ultimately make enough to make this a sustainable business. And then finally, the coherent funding plan. And this is really an important part of the fundraising strategy, which is to before you go out and start raising money, figure out, develop your financials, figure out how much you're trying to raise. And really what's very important is what goals you're going to get to with that investment. And because investors are trying to figure out how far this money gets you and what that next round looks like, or whether this investment round will help you get to break even, or if you're later stages, potentially it gets you to an acquisition or an exit. So those are some of the key things. So you always have to sort of treat this like a Mad Lib, think about how much money you're raising, how are you spending it, and to accomplish what in what time frame. And when I meet with entrepreneurs, and if they don't go through that, I probably will ask them about those. And then the final point here is about market realities. Is all of this has to be realistic with the current funding market. So yes, we would love to go raise $5 million now because it helps us do a lot of things. But if for a company that's pre-revenue, that might not be realistic. And so I think a lot of it is always keeping up with the market. Understand what the metrics are that investors are looking for in different stages. And the example I have here is from NextView. Again, this was from a couple years ago where they laid out the benchmarks that they were seeing in funding rounds. So, and then they broke it out by the business model type, which is consistent with what I was talking about earlier. If you're transactional, what are we looking for? If you're really consumer audience based or SaaS. And so it's really important to try to keep up with anecdotes of what investors are seeing, which will help you as you're planning your fundraise. And I've listed a few other resources that either have articles about this or they're active on Twitter. So those are suggestions I have to kind of really keep up with kind of what the market is looking like. And investors are really being transparent about their funding rounds and what they're looking for. So I think take advantage of that. And then final thoughts, kind of every investor is different. So what I've given you here is a bit of an overall framework, but I think you've got to allow for flexibility in how you present to investors, whether it's doing the research on them in advance and tailoring the pitch to them, or even just reading the room if you are meeting with them and listening to kind of what they're looking for. Even though I went through 8 or 9 bullet points, I don't view it as a checklist. You may not cover all of those things. You've got limited time in the presentation, so weight the things that are most important to your story, whether it's your strengths or that are most important to your business model, what an investor is going to care about. And as I said, the key is to communicate your story effectively. And then finally, in this COVID virtual world where probably most investor presentations are virtual, a couple of things that I've seen, because we've probably done about 70 to 80 pitches since COVID started. Crisp and concise is probably even more important. I think the framework of get my attention early with the big picture, and maybe even give me a summary of the key points of your business early on, hook me in early, and then kind of go into the detail. That's probably even more important. Engaging with the audience. And then the final thing, I have a 1/3 rule, and unfortunately I didn't quite follow it myself in this presentation, but a rule I really like to tell entrepreneurs is whatever time you have in the interaction, allow about 1/3 of its time for your content so that the remaining 2/3 can be for Q&A and discussion. So for example, and could be if you have an hour with a venture firm, then make sure your presentation only covers 20 minutes. So therefore the rest of the time can be conversation. If you're doing 10-minute office hours at the Three Rivers Venture Fair coming up, make sure your pitch about your company is about 3 minutes. So therefore you still have about 7 minutes to have the dialogue. So those were kind of some parting thoughts I want to share about engaging with investors in the virtual world. And then finally, I'm going to do a quick plug for our AlphaLab Health Accelerator. We're accepting applications right now. So if you want to learn more, or someone who's working on a company that's in medical devices, pharmaceuticals, diagnostics, or healthcare information technology, encourage them to check out AlphaLab Health. And then that's really what I had prepared. Thank you for listening. Happy to take questions. And then I've got my email address here and also my Twitter account. I try to share a couple things each week, articles I'm reading or thoughts based off things I'm seeing, and definitely sharing events that are going on in the ecosystem at InnovationWorks. InnovationWorks Twitter account is IWPGH, and then AlphaLab Gear, and AlphaLab Health all have Twitter accounts and Instagram accounts as well. So thank you, and look forward to taking any questions.
There aren't any questions in chat, but does anybody have any questions? You can feel free to unmute and ask them.
Yeah, so I have a question for the lab. So you just said that AlphaLab Health was opened until like late October, and what about the other like AlphaLab Gear and Generic AlphaLab?
Yeah, so AlphaLab and AlphaLab Gear are currently going through their cycles. We started the program in the summer, so it's been a virtual cycle, and we're working with the companies right now to sort of get to their final event, to present to mentors and investors and to help them with their next steps and fundraising rounds. So we would expect that the application cycle for AlphaLab Gear will open up probably early in the new year, and for a program that'll start next spring.
I see. Thank you.
And do we have any other questions? Does anybody want to give a pitch about themselves or the startup or anything while we have time?
Oh, I actually have a question.
Go ahead. Thanks.
So, hi Jim. So I'm wondering during the pitch. Oh, I'm sorry, with my hair. What if the investor asks you, say, oh, what is your exit strategy? But you're really in the state that you're just, you know, sometimes I get questions asked like, what will do if this happen, and what is your like exit strategy? And then it's like some things that I wouldn't know before I get the money and then start building things.
Yeah.
How would you tackle those questions?
That's a good one. And you know, the exit strategy question is probably one that there's a lot of debate about. So again, if you follow investors on Twitter, there's a group of investors that will say you should never ask a startup about the exit if they're early stages, because you know, I want to just understand what they're going to do to build their company. But then a lot of investors do ask that question. I think if you get that question, think about it in terms of your market and the industry you're going after, and just kind of make sure you understand the industry dynamics. So who are the major players? Who are the companies in your industry that may eventually view you as competitive, or that you may want to partner with that'll help you grow, because those often also are the likely exit partners. So I don't think you have to be very specific. You don't have to say, well, we think that we're going to grow to this in 3 years and then get acquired for this amount. But you could talk about, look, we think that what we're going to build is building a lot of unique value, and that when we do that, these are the type of companies that are going to be interested in acquiring us. And then, you know, so you could pick a couple of segments of the market. And so for example, if you were doing a product that had a lot of data for industrial applications, then you could probably point to a couple of the major players, the obvious ones like the Googles that would be interested in acquiring you for that data and going after those industries. Or you could imagine a couple of the major players in that industry wanting to acquire you because you've developed a competitive advantage for their industry. So I think that's probably the best way to handle it if you do get that question. But there are some investors that say, I don't want to see an exit slide in your pitch deck. And and those tend to be more seed investors that are on the coasts. I've seen that.
I see. So it will be safer to know what, like, if they want to see the slide beforehand, would you say?
I think so. I mean, you're probably better off just being prepared for that answer, maybe having it as a backup, but not necessarily put it in there unless you feel like it's a really strong part of your story.
I see. That makes sense. Thank you.
Sure.
So I have a follow-up question on this. So for a startup that has, let's say, a great team and a great potential market, but no traction yet, do you think these people can raise potentially some venture funding, or you need traction to convince the VC?
Yeah, that's a good question. I think first of all, if the strength of your story is sort of market and team, then you do want to build your pitch sort of around that. And I don't know if you can raise venture funding, but there's probably some pre-seed funds that you might be able to talk with, or angel investors, especially folks who really understand the industry. So not saying that you can't, and this is where I think raising money gets challenging, right? Because there's some markets that even if the company has some traction, they're having a hard time raising money. And then there's other markets that investors, or if investors already have a thesis or a belief in a given market or a problem, and you're solving that, and your team is really uniquely positioned to solve it, you may be able to raise money ahead of traction. But then, that's what's hard about it. I know that we had a company that was going after insurance in AlphaLab about 5-6 years ago, and they were pretty early, but because they had an incredibly compelling vision around the market that investors were trying to tackle, they were able to raise a pretty large seed round right out of the gate. And in fact, that company is called The Zebra. So I don't know if you see ads on TV for a company called thezebra.com, but next time you see it, that was a company that started in AlphaLab with a single founder in Pittsburgh.
I see. And so when you say that the team is very unique, like, does that mean every team member looks amazing in their specific abilities, or is it more like as a group they like they look different than we've seen before?
I think, look, it could be both. I mean, it could be that one of you has something that really stands out, that's unique, that's very important for the company at this stage, and the others are just very strong and solid. Could be that the team, the combination of you, kind of really jumps out. And investors are realistic. They don't expect perfection. They know there's going to be gaps. In fact, you want to be realistic about the gaps in your team and what you're looking for. And in fact, that's another basis of having really good conversations with investors, because that shows them that you're self-aware and really tells them how you're going to spend the money that you raise from them. Because often, when you're raising money, it's to grow the team and to probably invest in development and sales and marketing. So and in fact, that reminds me, one thing that you don't want to do is fill a gap in the team with the wrong person. You'd rather have that be open before you go into fundraise, because the investor feels like, oh, great, they need a head of sales. I really know someone that I could introduce to them and I could help them. So.
Yeah, I see. Thank you very much. That's great.
Sure. Thanks.
And I have a question in the chat. Ramesh is asking, do we have any nice investor pitch templates that he can refer to?
I don't have it. I mean, really, I kind of shared kind of how I think about the pitches, so you could probably orient your pitch around that. But I know that NextView Ventures, I feel like I'm talking about them a lot, but they've turned that Rob Go framework into a pitch template. So I do know that there are pitch templates out there. I always give a cautionary tale about pitch templates, because I know, for example, for a while there, we were seeing folks taking the Airbnb pitch deck and trying to customize that for themselves and using that as their pitch template, which didn't always work. So I think I'm more of a fan of sort of just think about the key things that anchor your story, and then kind of tell those in a set of slides in the best way possible. Because sometimes if it's templated, it comes across as templated. So.
Do we have any other questions? All right. Well, if we don't have any other questions, I can give everybody back about 20 minutes of their day. So thank you, Jim, for coming and leading this today. And this was great. And then